So welcome everyone, it's 4 o'clock sharp. So today we're going to go over what we're calling a tape reading entry gambit, and it's a how-to guide. And this is very important. Today's workshop is all about tape reading. We're going to just be tape reading today. We're not going to get through everything, so we'll continue next Thursday. And I think that this is going to be just incredibly fascinating if you're a trader and you've had some screen time. So, if I may, I want to show you what looks like an upside down head and shoulders pattern. If everybody's traded with me, they know that I'm pretty much a fan of the head and shoulders pattern for a couple of reasons. And that's because if you go back in time and you go back through the tape reading literature all the way to like Studies in Rolotape, which I think was published in 1902 or something like that, there are head and shoulders charts. Even as we evolved from the pits to the electronic exchanges, this pattern has not really degraded. The head and shoulders is still wonderful, and if you trade the head and shoulders, it's nice because it gives you the right shoulder, which is an ideal place to trade. So we're going to be spending some time on this, but we're not going to drill down too much into it. And I want to show you what we're talking about today. So first and foremost, let's just discuss what is tape reading, because that's what we're talking about today. And this is probably the most important foundation that we can all agree to. I'm sure everybody has a different definition of what tape reading is or is not and what it is, but this will be our working definition, and we'll be explicit about this so we can always come back to these things and say, this is what we mean. So tape reading, and let's be clear, is the ability to simultaneously, and that's a key word here, simultaneously monitor both changes in price and changes in order flow. So in the old days they used to call it tape, today they call it order flow, all the same stuff. And we do that so that a trader can more accurately forecast near-term changes in price. One thing about order flow is that what you read in order flow has a very short half-life. It degrades very quickly. But while it's present, it's very, very valuable. And the key here is this concomitant reading of both price and order flow. So tape reading is really having that skill set to say, oh, I see price action. For this price action, I should have concomitant order flow. If I don't, there is a discrepancy, and I don't have a clear crystal ball. And if I do have congruence or reinforcement of order flow on the tape behavior, on the price behavior, I should be in good shape. And that's really part and parcel of what we're going to talk about today. That's the bulk of it. And I think that's a very simple concept, and we're going to try to keep it very simple, but we're going to be very, very explicit and show you how that manifests itself in the market, particularly in the ES. So I think a lot of folks trade a lot of different markets. Today's conversation, we're going to keep it to ES. One thing that's critical to understand is that if you look at standard technical analysis, by and large, everything is predicated on changes in price. It's really a price action activity. Like if you look at a momentum indicator, and I just pulled this off of Wikipedia, momentum is really what they call the close today minus the close n days ago. So the close is really a price. It could be the close of a bar, it could be a close of the day, it could be close of the week, but that's what they're looking. They're looking at the rate of change of close. And here it is explicitly what the rate of change is. The close today minus the close n days ago divided by the close n days ago. So that gives you your percentage or your rate of change. All a function of price. It really doesn't incorporate tape or order flow. So just one critical distinction. I think if anybody knows me, I've probably said this before, that changes in price, regardless of the market, are predicated on changes in supply and demand. In the electronic markets, there's only one place to look for changes in supply and demand, and that's order flow. That's why we spend so much time on order flow, because we trade changes in price. What we're going to do here today is we're going to line up order flow with changes in price. And one of the things that we do is we're going to use a model. How to read the tape in 2 steps. Pretty easy. The following is the model that we use in-house at Algo Futures for our proprietary trading. When I'm trading, this is exactly what I'm looking at. This model has matured over the years. It has a lot of technology in it, and it's got a lot of effort put into it. I think it's a pristine, wonderful model, and I want to share it with everybody. We're going to be very explicit about what we're doing. First and foremost, you must maintain a market model. And what is a market model? There's all sorts of market models. There's like, Fibonacci and Elliott and market profile. There's all these wonderful market models, people, how they define the market and how they manage their market structure. For myself, I stick primarily with the head and shoulders pattern or an upside down head and shoulders pattern. For the purpose of this workshop and next week's workshop, we're going to stay in that, because I think if you saw the mailer that we put out for this workshop, we had a graphic of the head and shoulders pattern or part of it, and we're going to have very specific locales of what's going on in each of these and what concomitant the order flow must look like. Upside down head and shoulders pattern. This workshop came explicitly out of a question that was surfaced by an attendee at last workshop. We were going through some of the activity over here at the right shoulder. They said, yeah, but that is very difficult to see in real time. And that question stunned me for a second. And I was like, no, it's very easy to see it in real time, or at least I said that in my head. I realized that there was a very big gap on some of the basics of tape reading. I think it was 2 weeks ago, we had the last webinar. We stopped briefly and we went through a series of steps and questions of like, oh, how can you prognosticate the right shoulder at real time? And then concomitantly, what should you be looking for in order flow over here in real time? And we did get a lot of follow-up on that, so that's why we're having this. And our hope, our aim, is that if you see price going down like this in a downtrend, that just this, you can start teeing up an entire game plan to trade this, to see this, to trade this, to see this, to trade this, to trade this, to trade this. And it all starts with a down leg. And also all this will work in reverse. These are the 4 explicit locales in the head and shoulders pattern that we're going to be looking at. This is 1, which is the ultimate low, which is down here. So I didn't draw the whole head and shoulders. Excuse me for that. It's dink, dink, dink. We're starting here is number 1. So this is 1, your ultimate low. This is 2. We'll call this a recursion. This is 3. 3 is just above the recursion. This is where we know we have a lock on the right shoulder. This is 4, which is a point over here, similar to the high just preceding the right shoulder, and is a breach point for acceleration. We have some naming conventions here. 1 is the extreme low. That's down here. 2 is the first pullback. 3 is the confirmed right shoulder. 4 is the most recent pivot high, or a match or a breach with the most recent high. Let's drill down into it a little bit. And this is just from a high level. Let's see what we'd see down here. Down here at 1, at the low, the ultimate low, we have an expectation that you're going to see something called conclusionary selling. Some people call exhaustion, but we think that there's much more information in order flow than just a simple exhaustion. There's different types of selling that concludes. It may manifest itself in the state of exhaustion, but I wouldn't as relatively say it's exhaustive selling. And then frequently, you'll see the order book vacuum. If you look at the dome and you're watching this, sometimes you'll see the order book go bloop, and we're going to spend some time on that today. So Bruno's asking a great question. Bruno's asking, how can you tell for sure that one is a global and not a local low? So Bruno, we're defining it as the extreme low for the current trend for day traders, so it may not be the same. And we're going to put some rules of thumb in there to say, hey, it may or may not be. This one, it's a great nuance, Bruno, is the most extreme entry. And we'll document that. Why is it the most extreme? And then how to manage it, to take some of the extreme risk off of one. And Bruno, to answer your question explicitly, you don't know exactly whether it is the low, or just a little local low, what you're calling, which is a good term. So, one of the things, Bruno, to tie a bow on that, and that's why we call this a tape reading entry gambit. Because when you enter at 1, Bruno, it's a gambit. We don't know for sure. But we have rules for our gambit. When we're getting it 1 and this gambit, and we're saying, hey, I have a high degree of confidence that this is in all likelihood the global low or a supremely tradable low, that I have an expectation I'm going to have enough information when I click that entry. And I have very explicit expectations about what should happen immediately after I click that entry and I'm in. That's going to give me corroborating evidence that it was the tradable low or a non-tradable low. And that's where we're going to spend our time on today, Bruno. So thank you for teeing up that question. We tried to break it down into how to read tape in 2 steps. First is you maintain the market model. If you see a downtrend, you probably have an expectation of a high, a strong downtrend, a move up. Then if it's a strong downtrend, this will probably breach and you're going to have a lower low. This comes into Bruno's question, what's happening here that we have an expectation that this is, let's call it a tradable low. as opposed to a not tradable low. If we have a left shoulder here and your head shoulders here, and we then have this low put in, a tradable low, we've got two pieces of evidence in our sequence, our market model. That tells me if we see this corroborating evidence here and then here, I have an expectation of what I should see here. And then if this plays out well, I should have an expectation of what I see here. So as this thing marches through, Bruno, right here, this may be an extremely risky trade. But if this thing is rolling out in a picture-perfect sequence, not just price, but order flow, then by the time I'm over here on my right shoulder, I've got substantially more evidence that this is a right shoulder and is tradable. And then again, as we march through this sequence, if this right shoulder is also pristine, and I see pristine movement coming up here in order flow to this breach point, I'm expecting to go on. So we want to observe price and tape's adherence to the model. During periods of high alignment amongst price and tape with the model, traders have an inference that price will continue to adhere to the model, and hence there is an opportunity, as the expectation is that price continuum should also track to the model. Now, we consider ourselves extremely opportunistic. When the stars align, which happened a couple of times today, you could say, oh, the stars aligned, that looks pretty good, I'll take it. That's the opportunity we're waiting. We're waiting for the market to present its opportunity to us, then we're going to take advantage of that opportunity. And the opportunity is presented to us because we have an abundance of corroborating order flow information that matches with the price evolution of a head and shoulders pattern. Now, concomitantly, what's also as important is that if price and order flow do not track to the model, like, oh, we're making a lower low here, but instead of seeing conclusionary order flow, we see an increase in the rate of change of order flow, then this will not be a little low. This will probably get popped and it'll continue down. If so, we want to either get out of the trade or in fact go with the trend, go short at that point, but that's not what today's webinar. If price and order flow do not track to the model, we're going to either lower our profit target, and profit targets can be lowered to a loss level. We can raise your stop or you can simply exit the trade. In terms of the rule of thumb, this is what we're going to practice today. 1, where is price in the context of the model? When you open up a chart, you should be able to pretty much readily say, oh, I know where I am in the model, right? Here I am in the downtrend. If this is in fact the downtrend and I'm looking for a head and shoulders pattern, then I'm expecting this may not be the lowest low. It's going to go up, and then I'm going to have a lower low. Then I'm going to go up, and then I'm going to go down and have my right shoulder, and then I'm going to go up. And it's nothing more complicated than that. We do this over and over and over again. Because if I know this, then I know this, and then we have a breach of this, I have a high expectation of what my extreme low is. What's the price pattern here at my extreme low? What's the price pattern here at my extreme low? And if I know the price pattern and I know the concomitant order flow, it's now tradable. If it doesn't warrant and show up itself, I'm out of here. Now, Anthony's bringing up a very good nuance. He's saying that at the expected bottom in the head and shoulders pattern, how much jerky fluctuation should one expect before the pullout? So, Anthony, was the micro or macro H&S time frame? What I'm looking for, Anthony, when I see this thing, is not so much the price pattern. I'm looking at order flow. I'm looking at tape. So you kind of know it's going to go down, it's going to go up, it's going to go down, it's going to go up. Prices all over the place. You know, is this the low? Is this my right shoulder? Now I have a lower low. I have to look for a right shoulder. That's where we're always testing the water. And the trick is not to look so much as price, but to look at order flow. Order flow will tell you what's going on. Where is price in the context of the model? Price is down here. If we're doing Elliott, this is probably a 3 down. Question number 2. What does the model indicate should come next? Well, if the price is going down here and I see all this selling, I don't think this may be the ultimate low. I'm expecting it to move up a bit. Then I'm going to monitor the move up and I say, did what just transpire align with the model? Yes, we're going to continue trading the model. No, we're going to cease trading the model and wait for the next alignment of price and order flow to begin to transpire. This is such a critical point. Can we stop on this for a second? Now, there's a lot of different ways to trade. Everybody's got their own nuances. I'm very tied to this. So if the model is not transpiring, in all likelihood, since it's the S&P and this is a very consistent pattern, it's going to show up at some point again during the day. So it's not the goal then to trade every move, but the goal is to wait till we see the thing setting up clean again because we want to trade the model. This is the key tape reading entry gambit, like in a nutshell. No matter what we do, no matter where we get in, we're going to get in early today. We're going to show an exercise for that. We're going to show an exercise for getting late. We're going to show an exercise for getting in very late. No matter where we get in, either early, supremely early, the extreme low, Bruno, it doesn't matter. Wherever we get in, the tape reading entry gambit in a nutshell is that immediately after you enter, and we mean immediately, tape should come in right behind you. And when we say tape, what do we mean by that? Essentially, like for myself and our model, is that you should have corroborating McDaddy. Let's go through the scenario. If you buy here thinking this is the lowest low, or let's say you buy here, this is just an easier, and we're going to cherry pick some stuff just for this. I'll let you know when I'm cherry picking and when we're just going through like a bunch of data. So let me cherry pick this. Let's say you say, oh my God, this was an exponential move down. I'm going to pick the low. You would expect buying to come in. You want to see buying come in, and if buying can't come in because it's extreme, at least the selling should cessate. The selling should stop. And that's the marriage of changes in price, whereas tape readers were monitoring changes in price and changes in order flow. So if I move my mouse over a little bit, you can see that this is McDaddy. If you're not familiar with McDaddy, it's basically the easiest way to get your head around it is think of the rate of change of order flow on the Globex servers in Chicago. So if we're looking at the changes in price on a 4-tick range bar chart, which is kind of like a momentum indicator. Range bars are kind of like a momentum indicator. We got a lot of them straight or they're crossing each other and they're going sideways. We have downward momentum. We don't have downward momentum. The easiest way to understand where price is going is to understand the rate of change, the concomitant rate of change of order flow on the Globex servers in Chicago. So, oh my God, I bought here at the low tick. I'm genius. I bought at 21.15. And then I look down here on the close of this bar. I'm like, wow, they've been continuing to sell down here. The rate of change of selling on the Globex servers is continuing. Now I have an open bar here, 21.14.75. And oh my gosh, they're selling more. And we have this yellow tick ratio. We're going to be spending some time on it again today. I don't think that's the end. So if I'm reading changes in price and changes in tape, this may not be the end just yet. May not be the end. And that's what we're looking for. This is locale number 1, the extreme low down here. Let's look at a bunch of examples and see where, hey, if you picked off the same setup, did it work or did it not work, right? So the model is we're going to use price action to infer downtrend. That's not too complicated. I see price going down. We're going to use selling information to infer conclusionary selling. So we're going to look for what we call decrementing rate of change of order flow. That's the opposite of what we discussed here. We saw the increase of rate of change of order flow. And we're going to look for conclusionary selling events. And what could that be? People say that that could be a tick ratio, or that could be a high frequency trading sell surge, 2 standard deviation move in either the number of transactions or volume. All tape stuff, right? This is all tape. And then also you can support this analysis with support and resistance levels. So we're always looking at levels. What are my levels? As I come into a known level, are they selling it off through the level? Are they slowing it down? Is slowing cessated and gotten slow when I come to my level? And that's exactly what we're looking for. In terms of the extreme low tape reading entry gambit, there's a couple of different entries. You can have a standing limit order. So what does that mean? That means the overnight low is 15.25. I can have a standing limit. So in this case, I'm buying at 15.25. So this would be, I'm expecting price to briefly trade through the low. But this is a great nuance. Because if it's a double bottom, if you're expecting a double bottom on the overnight low, a bounce on that, you're probably not going to get filled at 15.25. You could put it at 21.15.50, and here you'd be expecting more likely to fill, but it will cost you more. And this is the analysis we all do coming into the low. If you had a standing limit order here at 15.25, you could say, oh, I do that all the time. I'm buying support. I'm buying the known support from the overnights. It should be safe. If you didn't want to do the standing limit order because you didn't want to be too gutsy, what you could say is, oh, I have a marker. I want to look to buy the low here. I'm looking to buy the overnight low. I want to buy support, and I'm watching price come down to it. I've got my hand on the dome, my finger on the dome. Oh, it's coming down. Yep, it looks like I'm going to get filled down here. Good, I'm going to be able to buy the low, right? At 954.13. I tick through 16 and a quarter. Next bar here. And I see MacDaddy decrementing a bit, right? As it's coming into the low, MacDaddy's decrementing. So I'm like, oh, that's good. I'll probably buy the low. Hopefully by the time it gets to the low, MacDaddy's going to be up here. That's what I want to see. This is kind of important, so let's spend some time on this because we talk about the concomitant reading of both price action and tape. Oh, I'm going to buy the low. MacDaddy slowed down. The rate of change of order flow slowed down. Moving down again. It continues to slow down. I have my standing limit at 15 and a quarter. I'm now 4 ticks away from my entry. I'm now 2 ticks away from my entry. But on the close of this bar, which is the open of this bar at 1550, the rate of change to the sell side is increasing. I'm coming into known support. Every trader, or most every trader who's trading the S&P knows the overnight low. Certainly every algorithmic trading bot out there has got it programmed into its memory and its trading routines. The overnight highs and lows are places where the bots are very active. It's a known high, it's a known low. So here, I'm 2 ticks away. On the close of this bar, which is the open of this bar, in real time, I have evidence that selling is speeding up. What I would highly recommend here on the open of this bar is to pull the standing limit order. If you were still looking to buy the low, and this is Bruno, the extreme low case, we're gonna go extreme low. The market pierces through, and as it pierces the known low, we see tick ratio. So this is what's called a down tick ratio, and it's actually a 2 standard deviation move in the up down tick ratio. And we have a proprietary tick ratio that we use. So it's kind of like time of day centric, and it does a distribution for all 1 point moves in the S&P. It kind of calculates what the up down tick ratio is, and then it just makes a distribution plot like a bell curve. If the up down tick ratio is extreme to either upside or downside by more than 2 standard deviations, it's going to plot this big yellow ball. So that means there was a lot of selling in the book, which is probably where the stops got hit and it pushed through. That fired all these orders that came down. My rate of change is still increasing to the sell side. So if I wanted to buy here, and I'm like, this is great. Maybe this is exhaustion. Maybe this is not, maybe this is the end of it. And you bought here, that's where it can get a little tricky. Very, very gutsy. Very, very gutsy. Let's look at the next bar. This bar occurred at closed at 956.47. It opened at 21.13. It had a low of 21.12 and a half, and it had another tick ratio. This dot is smaller than this dot. The big distinction here is this is a 2 standard deviation move. This plot's just greater than 1 standard deviation, between 1 and 2 standard deviations. That's the smaller. We're going to talk a little bit about candidate bars. So we have a concept of candidate bars, and this comes back part and parcel where we were talking 2 weeks ago at our webinar. Like, oh, what are my forward questions? How do I know that these things are going to happen in real time? Well, certain events occur in the market. And if this event occurs in the market, it should be teeing up the next event. So if you see something occur in the market that's teeing up the next event, we want to train your mind to say, oh, I saw this in the market. Let me go look it up. What should be the possible next event from this so I can get ready? This is the beauty of candidate bars. Here's a quick list I put together of candidate bars. So a hammer bar is a candidate for an engulfing bar. And if anybody uses range bars, engulfing bars often mean a reversal. So let's look at that. How do I know that this is a candidate for an engulfing bar? For us to have an engulfing bar, and this is the engulfing bar, the bar before it, which is this bar, has to have a small body. Make the job easy on the engulfing bar. So now we've had this move down, and I have 2 things going on. I've got this tick ratio. I've got the slowing down a little in MacDaddy on the bar before, and I have a hammer bar. This becomes a candidate bar for conclusionary selling. We'll probably spend a little bit time today on conclusionary selling, but not too much. But think of this. At this point on the close of this bar, and this tick ratio happened probably in all likelihood intra-bar, on the close of this bar, I know I have a candidate bar on the open of this bar. So now at 956.47, which is the close of this bar, and this is, let's call it 956.48, I say I may have conclusionary selling. If I want to buy the extreme low here, you've got a candidate for engulfing, and you may have conclusionary. Here I am at 1. Bruno was asking, how do you know if it's the ultimate low or you don't? This buy here is the most risky, but let's say you take it. We have 2 different entries at this point, a managed market entry or a managed limit entry. A managed market entry would be manually entering a market order intra-bar based on tape and price action. A managed limit order would be manually entering a limit order intra-bar based on type and price action. If you saw this open here, and then you saw the tail go up here, and then you saw the tick down here to 21.1275, and you saw the tick ratio come in somewhere between here and here, which is where it's likely to have come in, you have an inference that if I want to play the extreme low game, take it. And you could take it one of 2 ways. You can go to your dome. You could say, hey, I'm putting in a limit order to take it, or I'm putting in a stop, or I'm putting a limit in before. That's up to everybody's discretion what they like. I think people know I trade with Billy mostly. Billy's more of a limit trader. I'm more of a market trader. Billy has more patience than I do. I'm going to just fire it off and take it. Billy's goal is always to tuck it in much more aggressively. That's the nuance. So let's say you fired it off here. Let's say you got a market order. You probably filled at 21.1250. This becomes a critical bar. At the open of this bar, we're expecting, hey, I could have engulfing. And what should happen? Either McDaddy should certainly go green or decrement dramatically. So we do see that. We saw this thing become an engulfing bar. If you caught the extreme low and you're a genius, you're the world's greatest trader, you're great. You can now tuck in on the close of this bar up to here. You can move whatever stop you had. If you had a 4-tick stop or an 8-tick stop, you can tuck it into the low here or 1 tick below, or 2 ticks below, or 1, or whatever your trade management is. However you feel like that. The trade management's got to come down to a couple of known rules, and then take those known rules and look at your own capital allocation, how much time you have to nurse the trade, how much confidence you had in it, and how many of the stars aligned on this trade. Greg says you seem to be ignoring wind. Let's talk about that. We're not ignoring wind here. One of the things we look for often in tape is wind to come in late. So what's interesting here is that the market was here, 21.20, and then this whole move down, wind got red in the zone between 16 and 5, and then pulled down. There are times when you can see wind come in late. Like here's a more good example. It comes down, wind gets red, and then pulls off, wind goes blue. So that's what I'm looking for in wind, Greg. If wind comes in late, that'll be fantastic. But let's go through bar by bar. What happened here? We have the engulfing bar. Yay, I bought the low. Goes up. Strong tape imbalance. Not so great. The buying is not coming in strong. And if you remember, in a nutshell, the tape reading entry gambit that we just took, and we're taking the most risky trade, is in a nutshell, is immediately after you enter, tape should come in right behind you. So we took the gambit, we took the ultimate low, we're like, whatever, I'll go for it. Bar closes up, that looks pretty good. We had a decrement to McDaddy. McDaddy's certainly not green, but that's a good pullback. Next bar, pretty good, good pullback. Next bar, not so good. Not so good. At this point, you're going to want to think about tightening your stop up some more or waiting for the next one. And what happens here, the next bar, wind pulls back. We have equity high frequency trading reversal. So that means that we saw actually selling on the equity side by the high frequency trading box immediately covered by buying. So they must have been tagging the low down here. Went up, tick ratio, and down. We're still red. So now I'm long here on the extreme low. I'm 1, 2, 3, 4 bars over the course of 3 minutes, and I see no buying come in. If price and order flow do not track to the model, and the model is basically immediately after you enter, tape should come in right behind you, then get out of the trade by either lowering your profit target, raising your stop, or just exiting it so you can get out of here. Let's continue on through the model. Price ticks down, goes up. Gosh, but we have a low here, this low here. I'm going to look for a lower low or a right shoulder. Those are really my only choices. Lower low or right shoulder. Here we had the lower low, so we're out of the trade. But I have the lower low. If I have this low and then this low, I have a lower low. It says here a lower low is a candidate for a right shoulder. And this is one of the nuances we talked about earlier. When do you look for a right shoulder? The moment you have a lower low, you're looking for a right shoulder. So candidate for a right shoulder. Here's my first higher low, which is a right shoulder, and we're both going to trade like big and little, or little and tiny maybe, because we're day traders. But technically you have a left shoulder, head, right shoulder. Not much of a right shoulder, not so tradable, so I don't really care to trade it. There's no corroborating order flow that's going to say, oh, that's the world's greatest right shoulder, let me take that. So we ignore it. Price moves up, I'm watching price in action, price goes down, still a higher low. This could be good, right? This could be tradable, but do we have much corroborating order flow on here? Price moved down, and then it decremented. This is a candidate for engulfing bar, but price went down a little too far. We have nothing in terms of tape meter events here on this bar at 10:12:47, and again, nothing on this bar at 10:13:20. You could trade it, not trade it, but there's really nothing exciting here. The stars are obviously not aligning here. So the price moves up. Oh, look, here we have the buy programs waning, and we have this tick ratio, and then the price moves down, and then we had the extreme move up. We have this spike, this hard move up in MACD, and then it pulled back. So in real time, I'm thinking that this right here is pretty good. I don't trade this to the short side. I'm looking for the tell here to say, good, once I see this, I'm going to start looking for this. But this is pretty much it. The low was put in, things got softer, a little buying came in. Now I'm looking for this. As it moved up, right here, buy programs waning. That's what BPW means if you don't see it. And then we had the tick ratio. And if you remember from the webinar 2 weeks ago, the tick ratio, what we're looking for is how does price respond to the tick ratio. With the uptick ratio, price went down and closed at the low. That's conclusionary selling. As price moved up in this ABC, if you're an Elliott wave trader, MACD went chink, chink. Look at the acceleration of change, the rate of change of the rate of change in MACD. This is what we call conclusionary selling. From 1568 or so to 2 or 4 to 36, this thing may be ending. In real time, I'm saying this may be ending. I then see the buy programs waning. Oh, another good sign. The buy programs have waned. They're slowed down. Now my high tick and this is the money shot here. Now I'm pretty confident that the down leg is in. Ideally, I should trade this, but I don't. And price is going to go down. So I want to see the momentum come back to the sell side. Moves down. We have a strong tape imbalance. Little pop on that. Candidate for an engulfing bar. Here's your another right shoulder. Left shoulder, head, right shoulder. Here's a mini head and shoulders. You see these everywhere. As you see a higher high, the higher high is a candidate for a right shoulder. I actually have 4 in a row, 5 in a row, 6 in a row. 1 high, 2 highs, 3 highs, 4 highs, 5 highs, 6 highs. Lower high. There's my right shoulder on a micro scale. Fascinating. This is why I trade right shoulders all the time. It's unbelievable. And it's very easy to see these with range bars. It's unbelievable. Now I have a right shoulder that showed up exactly where I wanted to show up after this, which was exactly where I wanted to show up after this. So now, in terms of our model, where we talk about tape reading is the ability to simultaneously monitor both changes in price and changes in order flow, so the trader can more accurately forecast near-term price changes, and the head and shoulders model, we're in good shape. I'm now looking for this extreme low, this number one. How do I trade the extreme low? And we'll just go through it again. Price comes down. We had 2112 is the low, right? High frequency trading sell surge. Oh, do I want to buy the low? And they're selling a little deeper into the low. Ticks to 2112.25. Price comes up off it. We see a decrement in wind. If you bought this low, immediately after it, their tape should come in right behind you. We're not buying this low, but let's say you did. Price went down, and then the order flow is decrementing again. Probably going to get out. Now, just like we saw over here, we had the breach point. You have the tick ratio. You see this over and over again. It's unbelievable. And a candidate for an engulfing bar. Oh, good. This may be the low. Here's my candidate bar. I'm looking now for something to tell me. Let's say you take it. Now you buy on the market. Let's say you get a terrible fill. You're filled at 11 1/4. On the close of this bar, which is 1035.34. Let's say the open of this bar is 1035.35 1 second later. And let's say you bought the market. That's when MACD locks in over here. MACD will change intra-bar, but it freezes here. So if you bought this extreme low at a market at 21.12.25, you should know immediately, I mean immediately, as you're clicking the button, you should be saying, schmuck, why did you buy that? This thing's still not over yet. Right there, we see it on the tape every time. Unbelievable. Get out. So you take a 2-tick stop loss or a 3-tick stop loss or a 1-tick or whatever, depending on what your trade management is. But now, this bar, let's say you didn't buy. This bar closes, we have another candidate bar. We could have an engulfing bar down here. Sure enough, sell program's waning. On the close of this bar, decremented a little, I'd be nervous about buying this low. And then engulfing bar. Now the next bar moves up, we're green on MACD. Next bar moves up, we're green on MACD. We don't think it's going to go through the roof because already it's pulling back here. If this bar was here green, we're going to think it's going through the roof and we're going to be wanting to raise our targets. But here, not so sure. Tick ratio, engulfing. Now, here's a right shoulder. Here's my first higher low. Nothing too interesting going on. We do see a decremented MACD and wind is pulling back. So that's good, but nothing that interesting. So let's go again. Down, here's low. What are we looking for? If we're here on the new low, we're looking for this, then this. We have a new low, we're looking for this. Moves up, down, sideways, nothing really material here. Some mess, some sell surges, the orders were replaced, the buy program's waning. Again, the buy program's waning. Turns around, buy program's waning. And then the tick ratio, down and up. Here's my right shoulder. Anything to write home about? It's okay, not great. But what's important here is if you bought this, you're now at a right shoulder. You'd want to see the buying come in immediately. Right now, buying is neutral, and in turn buying, I'm saying MACD. Bar closes up, moves up, sell program's waning. That's always a good sign, but we want to see buying. Price is moving up, and buying comes in. Now, we see a shift, but still nothing demonstrable. If you've looked at any of our HFT continuation trades, if we have the right shoulder come in, and then the trade here 3, we're looking at 4. What's happening here? So the point here is low, higher low. Once you have a higher low, you want to look up and to the left and know what your breach point is. That's your high pivot over here. What's important to us is what happens with the tape over here. We often use the term, if anybody remembers the other webinars, breach with strength. 1, 2, this is your high frequency trading continuation. Here's here. I want to see MACD start to increase as I come through here. And then breach this with strength and breach this. So it's 21.14.75. Sure enough, it breaches with strength. On this bar here, I'm expecting it to continue. And it does. That's tradable. So even if you went market and late, we're talking about a very late entry, market entry, look at this thing going, you still had 2 points of room in here and you were safe. And that's because this 21.40.75 breached like it meant it. This is tape reading right here. It's the concomitant reading of both price action and tape. MACD goes through the roof, the tick ratio, and just like we saw before, where the tick ratio blew through here, and you're going to see continuation, you'll see it here. These aren't as pristine a price action setup, but this is pretty pristine. So let's keep going through. Price comes down. Let's say we're looking for a new ultimate low. We're looking, oh, look at this thing move down like it means it. Let's start a new head and shoulders. Let's start this pattern again. I want to grab the extreme low. Here's a breach. Price moves down. MACD pulls off a little bit. MACD moves down. The tick ratio accelerates, as does MACD, so we think it's going to continue. But this is a candidate for an engulfing bar, right? This is a candidate bar. Price moves down. Starts to slow down. Candidate for an engulfing bar, right? Because it's got the small body, decrementing MACD. Candidate for an engulfing bar. MACD continues to slow down, but lo and behold, this time we have simultaneously the tick ratio, the hammer bar, and a decrement in MACD. So if you wanted to buy the extreme low here, this one right here, hey, go for it. you fill on a market or an entry, wherever. If you want to limit fill one tick below at 1075, you're not likely to fill. If you just throw the market out, you're going to get it. So this is a very good extreme gambit. Immediately after you enter, tape should come in right behind you. These are very low tolerance trades. We use that term a lot in here, low tolerance. This is a low tolerance trade. So if you waited for the close of this bar, the open, and you threw the market out, you may have likely filled at 11. And that's really great because you only need a 2 or 3 tick stop. You're saying it's the extreme low. If you're not, you want to be out there. If you don't have Sceeto and you want to follow along, you can get a free trial. So please, if you want to follow along, get yourself a free trial. Price is moving down. This is not the extreme down, but hey, maybe I'm looking for my right shoulder. Well, let's stick to the plan. If I have my low here and it did pop, and we want to see buying come in right behind us, does buying come in? No, but selling decrements. Does buying come in? Selling increases. Getting nervous. I'm pretty good because I have a low fill here at 11. Tick ratio engulfing down. Could go. No, doesn't look good. I'm nervous here. This bar closes up. That looks good. This bar closes up. McDaddy is continuing to decelerate to the downside. Up, up, sideways. Where am I going to raise my target? Am I getting out? Boom. The close of this bar, I'm going to expect to see some follow through. Boom. McDaddy's increasing. I'm expecting to see some follow through. And then down. Let's look at this again. The hammer bar with the tick ratio. McDaddy's lower than this bar, but still not too material. What is it? -9? Not too bad. This is a candidate bar. A hammer is a candidate for engulfing. A hammer just above a lower low, a candidate for engulfing right shoulder. Mucho importante, we saw that. The lower low is a candidate for the right shoulder in terms of real time. What am I prognosticating? I see a lower low. I want to be thinking, where's my right shoulder? Higher high, also a candidate for a right shoulder. A bar whose low that equals the known low and appears as though it will close up is a candidate for a double bottom. If McDaddy is less than McDaddy a bar ago, it's a candidate for a resumption bar. If you have an opposing color McDaddy, it's a candidate for a resumption bar. If you have a tick ratio and a high frequency sell surge coming into support, these are candidates for conclusionary selling. I put the smiley face because that's what we've done here today, is the tick ratio coming into support, candidates for conclusionary selling. And then the extreme tick ratio coming to note support is a candidate for conclusionary selling. So if we have a candidate and we have an entry gambit, and a gambit means that there's a potential loss, we can take it, but immediately after that, we want to see tape come in right behind you. It should respond. Price should respond. This is a wait for the stars to align, take it, and then very, very tight stop. So hammer, candidate for engulfing with a tick ratio. On this bar, we have the uptick ratio and it closed. And here, this is good. The next bar is good. We see the buying come in immediately, right? We're good. Sideways, decrementing, not great, but not bad. Certainly slow. Sideways, good. Steady, 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 steady buying. What do we have again? Lo and behold, tick ratio and a hammer bar. That's an engulfing candidate. You can buy at market. You're going to fill at 21.45, at 21.1450, and then off to the races. We're going to do more of this next week. And what I'd like to do next week is more of these nuance. We spent time today on the hammer here at 1, the extreme, but we want to spend more time on 2 and 3. There are big distinctions in the entry between 2 and 3, which is we call 2 is the first pullback, 3 is your confirmed right shoulder. They're just a couple of ticks away from each other, but there are very important tells that you can know in real time. Oh, I'm getting in early here, I'm getting in late here, and I'm getting in early here and it's not working to my advantage, or I got in early here and it's working to my advantage, and now I maybe want to double down because I expect, once I see this, I should expect to see other things here at the confirmation. I want to go from 1 contract to 2 contracts. That looked great. I move up here and I see McDaddy coming in. I want to add 2 more contracts because my cost average basis is wonderful up here, and then I'm going to take that pop. That's what we're going to spend time on next week. So Anthony's saying that order flow is shaping the tradable curve, and the order flow visual indication tool is the primary motivator. I'm assuming tape reading embeds a high probability of anticipated direction in the mind of the trader over time with continued use of the tool you show here. I think, Anthony, you've said it probably better than I said it. Right. there's a high probability of anticipated direction in the mind of the trader. And what we're trying to do today and next week, Anthony, is to document that explicitly, so it's not nuanced and it's not like, oh, it's this. It's like, oh, decrementing McDaddy, tick ratio, hammer, should see an engulfing. McDaddy buying should come in and it should pop. So we want to be explicit, and we want to go through enough examples, Anthony, so it becomes second nature. And you can do this in a lot of different places, Anthony, but this is what's so cool. This model here, this head and shoulders, bump, 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 is occurring all the time on a micro scale and a medium scale, where we have a lower low and a higher low, and this over and over again. So it gives you a ton of tradable opportunities, and it's the same stuff every day. Arb's asking a very important question. He's asking, what's the distinction between trade ops and Sceeto? So trade ops and Sceeto, they go hand in hand. Sceeto is data. All the data you see, this wonderful order flow data, Arb, we create physically at the Chicago Mercantile Exchange, and then we take this data and we push it down to your machine. So Sceeto is a subscription service to all these wonderful order flow insights, and we surface those in real time. Trade ops, we're a trade recommendation subscription service. We're taking our trades, we're sending our trades up to the Sceeto cloud, and then those trades come to your machine, Arb, and you can automatically copy or piggyback those trades in real time. We surface our trades, the results in real time. If you're curious, oh, is this a good offering? Are they consistent? Just go here to Trade Ops and you'll see. I want to take a moment to thank Billy. I want to thank Alex. If you need anything, please open up a support ticket. Come to our webinar next week. We're going to do more of this. I hope this was interesting. And what we're going to do next week is we're going to just punch through these nuances over and over again today. So just like today, you saw the hammer with the tick ratio and the potential engulfing bar. This is an engulfing down. That's why it didn't work. You'll see over and over again. We'll find a bunch of the same things. And as a homework assignment, I would recommend everybody do this. Go look for head and shoulders, candidate bars, hammers, lower lows, higher highs. McDaddy is less than McDaddy a bar ago for resumption. Look for tick ratios and sell signals coming into support. So everybody has a homework assignment. We appreciate everybody's Trade Ops beta. We're looking forward to going to production. Everybody has a wonderful weekend, and we'll talk to you soon.
Sceeto's advanced algorithmic order flow data is now available within TradeStation, NinjaTrader, MultiCharts, and Sierra Chart. For more information, please visit www.sceeto.com.